thumbs up.
All right, okay. Welcome everyone. Happy Friday. Firstly, should always do the acknowledgement of country, so I want to recognise the elders, past, present and emerging, and just pay our respects to them. Thanks everybody for joining, either in person or online or on the Zoom. This is just an opportunity before we head into year end to have an economic update. I think the last one we had with Cam was highly successful, so come back for a repeat performance. We want this to be a really interactive session, so please feel free to, are we okay with asking questions along the way?
Definitely.
Makes it more fun. We're definitely not giving any listings guidance, so just so we say that up front. Your guess is as good as ours, as you know. But a really great opportunity just to hear from Cam on the state of the market and what's happening from an economic lens. So with that, hand over to you, Cam.
Thanks, Janelle. Thanks everyone for coming out today. So I'm going to just very briefly give you a bit of an economic overview because I know most of you get that internally. And then we're going to jump into listings right at the start because I know that's probably why most of you are here. And then we'll talk about more generally what's happening in the housing market. But let's kick it off. Just a couple of things on the economic side. So looking at lending, you can see that we saw a first rebound in new lending in about 12 months in March. Now that rebound's pretty moderate, and obviously lending has fallen a very long way from where it was at its peak. Peaked in January last year at about 33.5 billion, so it's come back a long way. But the rebound in new lending in March really reflects the uptick we've seen in sales volumes so far this year, and it also reflects the uptick in prices we've seen, particularly in Sydney so far this year. Now, there's three components of new lending. There's lending to investors, lending to first home buyers, and lending to subsequent buyers. All three of those segments did see an uptick in March. Probably out of all of this though, the most important thing is first home buyer lending has been trending lower since January 2021. So that's the first uptick in a very long time. And lending to investors, this share of lending to investors has been below its long-term average since the middle of 2017. And this, when we get to talking about the rental market, explains a lot of what is happening in the rental market at the moment. The one area of lending that's been really strong is refinances. With interest rates moving pretty much every single month for the last 12 months, people have been shopping around for a better deal. But also a lot of people that fixed their mortgage rates during the pandemic are now coming off those fixed rates and trying to refinance. But as the Reserve Bank has said, about 16% of people aren't actually in a position to be able to refinance because they don't pass those serviceability tests anymore. But I did notice just this week, some lenders now offering products whereby your assessment rate is only 1% above the interest rate you're offered rather than the 3% we've been looking at. So that'll be interesting to see, but certainly that will allow people that weren't previously able to refinance the opportunity to do so. So with with interest rates having increased so much, so going from 0.1% the cash rate a year ago to 3.85% now, the borrowing capacity for a lender has fallen by more than 25%. And this just shows you what the mortgage rate and what the assessment rates are. The dotted lines there are because the data is a little bit lagged. So we've just assumed from the most recent data we've got that the borrowing rate's gone up as much as the cash rate has. So if you're an owner-occupier at the moment, 5.67% is the average mortgage rate. The assessment rate, though, is 8.67%. So now you're getting upwards to 9%. That does have a big impact on your borrowing capacity. And if you're an investor, it's even more. So you're looking at being assessed at 9%. And again, we get asked a lot, why aren't investors coming into the market when we've got the rental situation the way it is? Another big part of it is you're servicing your own mortgage and then you're trying to take out a mortgage for an additional property. Banks are going to lend you significantly less. Prices have come back about 6%. Borrowing capacity is down around 25%. So it's hard to make that stack up. And there's a few other reasons we'll talk to a little bit later as well. The other big thing that's changed over the last 12 to 18 months is population growth. Now, the data from the Reserve Bank is really lagged. From the ABS is really lagged. It's only up to September. But what you can see is nationally there's two components of population growth. there's natural increase, so births minus deaths, and then there's net overseas migration. And more people were leaving Australia than were coming to Australia during the pandemic. Fast forward to the start of last year, so the March quarter of last year was the strongest quarter ever for net overseas migration into Australia, and then that was eclipsed in the September quarter of last year. So we have seen a rapid ramp up in the number of people coming into the country. If we look at more up-to-date overseas arrivals and departures data that we do get every single month from the ABS, we can see that there is still a huge volume of people coming in on permanent and long-term visas into the country. And the reality is most of those people, a lot of them will try to stay long-term, but when they get here, most of those people don't have their own property to live in. So this is really impacting on the rental market at the moment and creating additional competition in that area. That's all I'm going to talk about in terms of the economic side of things. So as I said, we're going to jump into listings because I know that's what everyone's probably most interested in.
Yeah. Another question. What do you think around the number of interest rate hikes that has come?
Good question. We're just talking about this before. So for those online, the question was around how many more interest rate hikes. I think we probably get another one at least. That's likely not until August. So that's when we get in end of July, the next quarter CPI data. I think there's a real possibility we get one more then. Thereafter, maybe another one, but I think it's less clear. So I think it's probably one, maybe two more interest rate hikes. But I kind of agree with what Ross McEwen from NAB said. It'd be better if we just got the interest rate hikes over and done with quickly, so we could all move on with our lives and we had a bit more certainty instead of it dragging out even longer than it has to. So before I go into listings, I wanted to highlight to you some of the feedback we're getting about the listing environment from our customers and what they're saying to us. So I go out and present quite a lot and I always try and ask questions of our customers and gauge what the situation is, what's the feedback they're hearing from potential vendors, why aren't they bringing properties to the market at the moment. So this is what they're saying in terms of the broader market. So there has been, so far this year, a meaningful increase in the number of people coming to open homes and bidders at auctions. I was in Sydney about a month ago and I was talking to some people on the upper and lower North Shore. And I'm saying, we're getting 35, 45 people to our open for inspections. Often we're getting at least a couple of offers at that first open for inspection. They said they haven't seen those conditions since sort of the middle of 2021. So the start of this year was really a reversal of what we had seen for most of last year. Buyers have certainly come out of the woodwork a lot more so. There's definitely a sense that people that have a number of investment properties are getting stretched. I've heard a number of anecdotes right around the country that I've got someone that's got a portfolio of 7 investment properties and they're now being very stretched by all these interest rate increases and are having to look at selling down that portfolio. There's also a lot of those people that are nearing retirement age and looking to sell down that portfolio now as well. Now, net, if a renter buys that property, that's obviously doesn't really have an impact on the market because you've got someone that's renting, transitioning to home ownership. But with so many people coming into the country, if people are selling down investment properties and they're not being returned to the rental market, it is thinning out the overall supply of rental stock, and that is a challenge. So one of the big problems that we're hearing is that people are aware that they can sell their property. They're fairly comfortable, particularly this year, that there has been a rebound in the number of people out there at open homes and looking to buy properties. But they're all saying, what's next? Okay, I sell my property, but what do I buy? And because there's very little stock on the market and there's very little stock coming onto the market, they feel like, they're going to be out of owning a property for 6 to 12 months or maybe even longer. They also know that they can go to the rental market, but the rental market's such a mess at the moment that if you have to transition through the rental market, it's very hard to find accommodation. And if you want to stay in the same area that you are, if you've got kids in school, you run the risk of maybe not being able to find somewhere to rent and having to move away from the school zone. So I think that's providing a lot of reluctance for people to list their properties at the moment. Certainly that's a challenge for us. And just more generally, a lot of lenders are now telling people that if you want to buy a property, you have to sell first. So again, that's meaning that they're having to transition through that rental market. And with rental vacancies the lowest they've ever been, it's very hard and not very appealing for a lot of people to be doing that. The discussions that the agents are having with vendors are that the volume of stock's very low. We are seeing prices rise, and that's the conditions you want to be selling in a market. No, a lot of the feedback is, oh, we'll wait to spring, we'll wait till later. And agents are trying to convey to these people that you don't know what the conditions are going to be like later. At REA, we did forecast this year that prices would fall 7 to 10%. And if you look at most people's forecasts, they were for prices to fall that much or even more this year. We truly believe the main reason why prices aren't falling is because there's a real lack of stock available for sale, and there has been that uptick in interest in properties. If there was a lot more stock on the market, I think it's conceivable that maybe we would be seeing prices continuing to fall. But at the moment, people buying don't have that scope to play properties off one another because there's not enough of them that they're really willing to buy. So they can't really get themselves a really big discount that they would be able to if there was a lot more stock out there available for sale. The other thing is, buyers were largely on the sidelines through last year, and we'll talk to that a little bit later, but they've done a lot of research. They've done a lot of time. They've spent a lot of time on our website looking at properties, gathering information, and they're very discerning. The agents are saying these buyers at the moment are very informed. They know what's sold locally. They know what price to pay for these properties. And they're also really discerning about features of the property. So one of the big pieces of feedback we're getting from real estate agents is people don't want properties that need any work. I was at an agency in Five Dock a couple of weeks ago. The guy said to me, it had a fence that needed complete replacement. And basically no one was interested in that property because they didn't even want to do the work to try and find a tradesperson and replace the fence because they just knew it was too hard at the moment. So people want fully renovated properties that you can just walk into and not have to do anything to them. Anyone that is selling a property that needs significant renovation or work, it's a very hard sale at the moment. But people are also more willing to sacrifice on location. We have heard because of that lack of stock, people are looking at busier roads than maybe they would have sort of 12 or 18 months ago, and more willing to accept properties in those they're less than ideal locations. And that was basically my next point. So people want those properties that they can just walk into, move into, no more work, not having to get any trades, not having to try and do any work to it themselves. So let's have a look at listings. So what we've got here is a chart, and we've got a few charts that look very similar to this. So the red line is the monthly average number of new listings over the 5 years to last year. The grey line is what happened last year, and the black line is what's happening so far this year. So you can see the number of new listings in April was down 24% from a year ago, down 25% in the capital cities, 21% in the regional markets. Now, April's always a seasonally slower month because you do have Easter, you often have Anzac Day, you have school holidays. So you have fewer people bringing properties to the market, but that is quite a large decline. If we look on the right-hand side at how those declines look, so you can see in Sydney, new listings were down 25% from a year ago. In Melbourne, they were down 22.5%. In Brisbane, down 32%. And then have a look at the 5-year averages as well. We can see quite large declines in the number of new listings in that market. If we look at in Sydney, what's happened, and what we've got on the right-hand side here is looking at the SA4 regions of Sydney. So they're just standard geographies. You'll be pretty familiar with those locations. So Sydney new listings are down 25% and they're 17% below their 5-year average. If you look at the biggest annual declines, you can see places like the Central Coast, the outer southwest, and then you look at the 5-year declines, some quite large falls in places like the northern beaches, eastern suburbs and other parts of the city as well. So Sydney's definitely seen a bigger decline compared to the 5-year average than when we look at Melbourne. You can see the number of new listings in Melbourne was down 22% from a year ago, it was only down 14% from the 5-year average. And you can see again across the Melbourne SA4 regions how that's playing out, that we are seeing those declines. So the number of properties coming onto the market is already low typically in April, but it was very low this year. We're seeing, just a lack of willingness for people to bring properties to the market at the moment.
So, Cam, was the 5-year average a good benchmark?
Sorry?
Why is the 5-year average a good benchmark, and what else is that telling us?
The 5-year average takes in 2018 and 2019, so before the pandemic. Now, 2019 was a bit affected by the Royal Commission going on. Then we had 2020, which started out as a fairly normal year, but then obviously we went into lockdowns, and then obviously the last couple of years have been very strong in terms of new listings. So just a longer term view of how the market has performed over that time, and taking in a few different parts of the cycle where we had fairly normal conditions and quite abnormal conditions as well. From there, we don't tend to talk too much about total listings, but total listings are also a really important consideration for the market. So if you think about how people buy properties, you basically decide that you're going to buy a property and you look at everything that's on the market, and you either are interested in that property or you're not. So total listings are a little bit higher than they were a year ago, but they are a long way down from their 5-year average, and we have been seeing this ongoing decline in total listings. And then if you don't buy something that's already on the market, you're basically hanging out for new listings to pop up to try and purchase that property if it's the right one for you. So you've got a historically quite low number of properties on the market, so not a lot to choose from when you start looking. And then you've got very few properties coming onto the market each week or each month to choose from when you're trying to buy a property as well. So it is a real challenge for buyers that there's just not a lot of choice out there at the moment. So if we have a look at how that looks, so you can see in regional markets, a lot of them, we have seen a big increase in the total number of properties on the market. Regional Victoria up 40%, regional New South Wales up 35%. Hobart has seen a massive increase in the number of properties on the market. But then you can see in Sydney, it's down 8% from a year ago, marginally higher in Melbourne, a little bit higher in Brisbane and Adelaide, quite a big fall in Perth. But if we compare things to the 5-year average, you can see really large declines in Brisbane, really large declines in Adelaide. Not insignificant declines, but smaller declines in places like Melbourne and Sydney as well. So if we look at Melbourne and Sydney, so this is looking at Sydney total listings, they're down 8% from a year ago, and they're down 9% from their 5-year average. In terms of the areas of Sydney and New South Wales, you can see that a lot of the regional markets have seen a very large increase in the total number of properties on the market, whereas most parts of Sydney, except for the outer areas of Sydney, so you can see the outer west and Blue Mountains, you can see the outer southwest, you can see the central coast has seen a fall, but those outer areas have generally seen a little bit of an increase in supply relative to a year ago, which really talks to the fact that during the pandemic, everyone was trying to get out of Sydney or get to the outskirts of Sydney to get more space. Now it's all about coming back into the inner city areas and the middle ring areas and looking for those blue chip properties. And the supply of stock in those markets is very tight. And if we look at Melbourne, a bit of a different story in Melbourne. So the number of total listings is pretty much flat from where it was a year ago, and it is actually slightly higher than the 5-year average. But again, if you have a look at what's happening throughout the state, so the more desirable inner city areas have seen a big decline relative to the 5-year average, and the outer areas and the regional markets have seen a big increase. So moving from what's happening with properties for sale to rental listings. So we jump in here, and again, about the rental market, this is what we're hearing our customers say. Rent rolls, they're reducing, so we are seeing a heightened number of investors exiting the market. Now that's been a feature basically since the start of COVID. There we go, it's back. But what we're not seeing is enough investors coming in the front door to replace all of that stock that's being sold. And I was talking to a few agents this week in Melbourne, and they were saying, no, we're seeing quite a lot of instances of people that are going to their landlords and buying the property directly off their landlords at the moment as well. So again, that's thinning out. I mean, that's someone that is renting moving into ownership, but it is thinning out the overall supply of rental stock as well. Basically, though, we're seeing significantly more higher levels of demand for rental properties, and that's really giving landlords a lot of scope to lift rents. A really good example of this is in inner Melbourne. Unit rents in inner Melbourne are up 25% in the space of 12 months. Now, they did fall about 18% during the pandemic, and they're only just marginally higher than they were at the start of the pandemic, but things are ramping up really quickly as more and more people come into those inner city areas looking for rents. So what's driving the demand? There's basically two sources. There's the overseas arrivals. As I said, people come to Australia, they don't own a home yet, they need to find somewhere to live, and that's usually in a rental market. It's usually renting close to where they're going to university or close to where they're working. And the other source is a lot of people that moved away during the pandemic. You know, a lot of businesses are now telling people they have to be back in the office on a more regular basis. There's a lot more reasons to be in the major capital cities again now. You know, during the pandemic, there was no sport, no cultural events on, offices were shut, so there was no real reason. A lot of businesses shut down as well. Now things have come back to life. People want to be back where all that activity is happening, and that is largely in those inner city areas, which is that point there. And I think more generally though, there's really little meaningful boost to rental supply in the pipeline. Now, we talk about build to rent, and obviously that's a new and growing asset class, but even for the next 6 years, nationally there's about 26,000 units in build to rent coming onto the market. And if we look at what's happening in terms of new housing development, particularly around apartments, developers basically can't make 1-bedroom apartments or 2-bedroom, 1-bathroom apartments stack up anymore. So all of the new development is targeted at owner-occupiers, particularly downsizers. So you're not getting too many of those, 500 apartment buildings. A lot of them have been scaled back and are largely 2-bedroom, 2-bathroom, 3-bedroom apartments. So that's not really adding to the rental stock in the market. It's adding to owner-occupier stock. Basically, for rental stock, you're relying on investors coming back into the market and that build to rent, which isn't offsetting the amount of investment properties we used to get in build to sell. So given that, there's not a lot of chance in the short term that those rental shortages are going to go away. Basically it's either demand or supply. The way to slow demand is to shut the borders or dramatically reduce migration. I don't think the government's going to do that. The other option is to get people into their own home. That's obviously quite difficult at the moment because interest rates have gone up a lot, borrowing capacities have reduced a lot, so it's hard to make that leap out of renting to buying, or to meaningfully increase supply. And that, if you build more homes, that takes time, and we know that there's not a lot of investors coming back into the market at the moment. And just more generally, we are getting the feedback that because property managers are getting so many people turning up to open for inspections, there's actually less of a need for them to put those properties on the market because they know they've got 40, 45 people that have turned up to a rental inspection, and they can just say to the owner, well, your lease is coming up. I've got 45 people that would be possibly interested in that property. So it's maybe not as necessary to put that property onto the market at the moment as it would be if we had higher vacancy rates in a more normal market. So if we have a look at new rental listings, same sort of chart here. So you can see rental listings nationally were down 2% from where they were a year ago. And they've seen a bigger decline. They've seen a decline in the capital city markets and an increase in regional areas. So the big things to note though is that new rental listings, particularly in Melbourne and Perth, have seen a big decline over the past 12 months. And relative to the 5-year average, you can see big declines in Sydney, Melbourne, Brisbane, Adelaide and Perth. So we do have a very tight volume of stock or low volume of stock on the market relative to what we've usually seen over the past 5 years. Sorry, there's a question.
Question on why. I think it may be back to the slide you were just talking about. Eric has asked whether you have any data on vendor appraisals or comparative market analysis that you can show us or talk to, and what is the usual lag time between appraisals versus actual new listings?
I don't know that we've done too much analysis on that as yet. used to work for another company that does CMAs, and we did find that the lag between doing a CMA and getting the property on the market was usually 4 to 6 weeks. So, you know, if you're at the point where you're talking to a real estate agent and you're getting that market appraisal, you're pretty close to making the decision to talk to to select an agent and get that property onto the market. Where were we? Total rental listings. Again, total supply, probably in the rental market more important because people are just trying to find anything at the moment to rent. And you can see that it's down quite significantly, down 9% from a year ago. A big fall in the capital cities, a big increase in the regional markets. But have a look at Melbourne. The total amount of rental stock in Melbourne's down almost a third in the space of 12 months. It's down 15% in Sydney. It's increased a little bit in Brisbane and Adelaide, but if you look at that 5-year average number, significantly less stock than we've typically seen over the past 5 years. And Perth is the other interesting one, a big decline in rental supply in Perth. Yes, Janelle?
What do you think is going to happen post the Victorian budget around
Good question.
landlords?
So the question for those online was just about the Victorian budget and the impact on that. I think the obvious one is because the rental market's so tight at the moment, landlords are going to look to recoup that cost. Now, they might not be able to recoup all of it, but I certainly think it's going to encourage them to put up rents more than maybe they would have otherwise.
And maybe for the Sydney people, maybe say what the
Oh, okay, sorry. For the people in Sydney, what that change is they've increased land tax on property investors in Melbourne. So it's going to add about $1,300 a year additional land tax. And it cascades. So if you own, 6 investment properties, that increase is much larger. So it's anyone that owns at least one investment property is getting an increase in their land tax. The other impact will be that people in Australia have a choice where to invest, and it's going to make Victoria a less attractive place to invest. You can already get much better rental returns going to WA, going to Queensland, going to South Australia. So it's going to discourage people from investing in the Victorian market, which is not good because looking at this, Victoria is where we need rental supply more than anywhere else probably at the moment.
Just a question on rents and I guess your interest rate outlook.
Yeah.
If rents are going up and the shortage persists, should we not be expecting rates to be also going up more for longer until that the inflation basket is taken care of?
So for those online, that was the question about if rents are going to continue to inflate, basically. They're a big part of CPI and that will push inflation up more. I guess a lot of people are forecasting that we're now at the peak of the cycle. And that's one of the reasons why I think we probably do get at least another 1, if not 2 interest rate hikes, because rent is the second largest component of CPI, and there's nothing meaningful that I can see that's going to bring that down. Now, the cost of everything else might come down, but I do think we're going to continue to see rental inflation for some time, and that is going to mean that it's a harder job for the Reserve Bank to bring inflation back down to that target range. And then the hard thing I think at the moment is the Reserve Bank have said that they're happy for inflation to remain outside of the target range for longer. If you look at what other central banks are doing, they're lifting rates much quicker and trying to get inflation down quicker as well. Whereas here, the rhetoric from the Reserve Bank is, well, we want to try and maintain those labour market gains and keep some of those, the lowest unemployment rate we've seen since the 1970s, and we're happy to bring inflation down slower. Now, whether that's the right approach, I think probably not, but that means they're going to have a bit more of a tolerance for higher inflation than a lot of other central banks would. There's another question there.
Another question from online. Where do new listing volumes sit if we express it as a percentage of housing stock? If it's 5%, does this imply average holding periods are 20 years? Does Cam think this is too high or too low versus history?
So the average holding period at the moment, so you're looking in terms of this, I don't usually look at it in terms of listings, I look at it in terms of sales, but you're looking at about 5% of housing stock turning over in a given year. And so that implies a 20-year hold period, basically. What we did see was 2017 was the peak in the proportion of properties coming onto the market and selling. and it has dropped away. And obviously with the low listing numbers now, it's probably stretching out to sort of more 22, 23 years if you were looking on a listings basis. But it's something we can go away and have a look at a bit more closely. I wanted to also touch, oh, there's another question?
Sorry, another question.
Yeah.
Can you explain why landlords selling off their investment properties worsens the rental market? It seems to me that for every unit of supply that gets removed from the market, you're also removing one unit of demand. If anything, you'd expect some situations where multiple renters move in together into a purchased dwelling, and there's also less frequent turnover in buying compared to rentals, so you have less vacant living space over time. So on net, you're removing slightly more demand than supply from the market.
Potentially. I think if you didn't have this rampant rate of population growth. So yes, if a renter buys, that means someone's moving out of a rental property and someone's selling a rental property to them. You are, net, there's no difference. But the fact is, we've already got that undersupply of rental stock, and you need a lot more rental stock because there's so many more people coming into the country, and we're taking away that supply. One thing that we haven't touched on here is what's happening on our Flatmates platform, and we can see, during the pandemic, a lot of share houses broke apart. People were working from home. If you're living in a share house with 5 other people, it's very hard to work from home during those situations. And in somewhere like Melbourne, rents fell by about 18% in those inner city areas. So a lot of people did leave share houses and move into their own properties. So the average household size fell quite a bit. What we are starting to see is more people signing up on Flatmates. So more people looking to save money by going into that share house accommodation. And that's probably the next logical step. When we do get to a bit of a chat about the rental market, you can see that house rents have escalated much quicker than unit rents. So if you're in a house, the logical move is to go into a unit to try and save rent, and maybe go into a unit that you can share with someone. And then from there, if things get too tight, the next logical step is to move into a proper share house. And I think we will see more of that going forward as the cost of renting gets restrictive. I think, though, the important thing in Sydney and Melbourne, yes, rents are rising at a rapid pace, but they're not that much higher than they were at the start of the pandemic. I think I've got it later, maybe not, but I think rents in Melbourne are only up about 6% since March 2020. In Sydney, they're only up about 9%. Whereas you go to somewhere like Perth, they're up 35%. You go to Brisbane, they're up 30%. Adelaide, they're up about 30% as well. Another question?
It's similar situation, but the UK has similar rental inflation compared to Australia without similar levels of immigration. Isn't rental inflation just monetary inflation?
It's, rental inflation is still lower than overall inflation at the moment. And I think one of the tricky things with rental inflation is it looks at all rentals. Most of our data certainly is based on advertised rents. And you do find that the rents that are getting advertised, so when people leave, landlords do tend to try and put up rents a lot more than maybe they do for people that are staying. So our advertised rents are stronger than rental inflation. So I think the CPI component of rents up about 4.8% over the past year, whereas headline inflation's running at 7%. But I think what is expected is inflation overall is going to come down, or slowly come down, but rental inflation is going to continue to escalate. Hopefully that answered the question. I'm going to move on to what's happening in the new homes market. I did want to touch very briefly on that segment of our business and what we're seeing. So this here is looking at the number of project profiles that we have on our site for apartment, land estate and retirement. So you can see the year-on-year change. So there's now actually more land estate project profiles on our site than there was 12 months ago, but there has been this dip in the apartment segment. Now, retirement's up, but retirement in terms of the number is still pretty low compared to apartments and land estates. And then you can look at it over time on the right there. So you can see that the number of land estates, yes, it's higher than it was a year ago, but there's fewer land estates selling, or at least advertising on our site, than there was at the start of the pandemic. And you can see early on in the pandemic, a lot of people got to market pretty quickly. In terms of apartments, though, we're seeing slightly fewer apartment projects on the market. You can see that's been trending down basically since the beginning of 2021. And the reason for that ultimately is it's very hard to make an apartment project stack up at the moment. If we look at what people are trying to develop, it's sites that they bought in 2017, 2018, 2019, right at the peak. So they paid a very high premium for those sites. And then if you look at how much materials cost, they've escalated by about 11.5% over the past year. And that gets passed on to the end user. So if you're looking to buy a brand new property, firstly, you don't know when it's going to get delivered. A house used to take 6 months to build, and a house can now take 2 years to build. An apartment project that maybe took 3 years before to build could be taking 5 years. A lot of the developers have got to get a level of pre-sale to go ahead as well. And this doesn't take into labour costs as well. So if you're looking to buy a brand new property, you don't know how much it's going to cost, and you don't know how long it's going to take to build. And some of the other feedback I've got is people are very aware about builders, so they want to know, have you got a contract in place for a builder before they're willing to sign, and they want to know who that builder is as well, because even, as we've seen, even some high-profile builders have fallen over the last 12 to 18 months. So it's a real tough sell in that new housing market at the moment. Another question.
Borrow capacity is 25%, but property prices fell 8% and now rising.
Yeah.
Why such a big difference in these two numbers?
Yeah, it's the question we get asked a lot, and it's a question we don't have a great answer to. Now, just because borrowing capacity is down, not everyone borrows the absolute most that they possibly can. So you wouldn't necessarily expect prices to fall as much as borrowing capacity has. But the reason why we've started to see this reversal in our mind is basically the listing story. If there was more stock on the market and there was more stock, new stock coming to the market every single month, people would have a lot more choice. But because the amount of stock when you first start looking is very low, and then when you have decided maybe not to buy those properties and wait for something to come onto the market, there's very little of that stock coming onto the market. There's not really a lot of potential for buyers to negotiate a really cheap price. And that's really been the thing that's stalled these price falls. Now, again, if we were to get a lot more stock coming to the market, you might find that prices start to fall again. But we won't know until that happens. But I certainly think that's a feasible situation. If we did see a big increase in supply, prices would start dropping again.
Do you think we need to have a shock to sort of break out of this cycle? Do you think it's something that sorts itself out over time? This rental story is not very healthy.
No.
It doesn't sound like it's getting better. You know, the concerns of selling and not being able to find isn't going to get better by itself. So what needs to change?
Yeah, it's a tricky question. I think people need certainty. Like if you look at consumer sentiment, it's pretty much the lowest it's ever been. It's at levels we haven't seen since the GFC, since the 1990s recession. And the economy is way stronger now than it was in either of those two periods. I think sentiment is more heavily linked to interest rate movements. So last month when interest rates didn't change, we saw the Westpac measure of consumer sentiment rise by, I think it was about 9% over the month. So I think a lot of sentiment is to do with interest rates. And I think if we can get to the point where there's some certainty on interest rates, even that, it's very clear that this is the peak of the interest rate cycle, I feel like then people are just going to get on with things. They know that they're not potentially facing more hikes in the future. They know where they stand in terms of what their borrowing capacity is. They don't have to worry, well, if I don't buy this month, is the mortgage broker going to tell me I can't spend as much next month when interest rates have gone up again? So I feel like you need that certainty to start kicking things along. When we get that, who knows? As I said, I think we probably still get another interest rate hike in August and then maybe another one thereafter. But if we could just get to the peak of the interest rate cycle sooner, I think that would be good for us and that would be good for the industry.
Cameron, do you think you've got a backlog of listings that built up for people who wanted to normally be transacting but not been transacting? At some point they just kind of got that backlog comes onto the market.
So the question, you might not have heard that online, the question was, is there a backlog of listings? I I think there is somewhat. Measuring how much, I mean, some people will just go, oh, I would have liked to have sold, but now I'll do a bit of a renovation and stay where I am. So I think some of those listings do come back. Whether all of those properties that would have come onto the market during that period come back, I'm not so sure. I think if you decide not to sell, you probably don't change that decision in the next 6 to 12 months. You maybe look at it again in another couple of years. So I don't think just automatically once you get to that point, all those people that would have listed then start listing. But I definitely think there is somewhat people waiting for that peak in interest rate cycle and a bit more certainty to make the move.
At what interest rates does the buyer side become a constraint on housing side? It looks like the constraint right now is from the seller side because the housing mobility is down. Is there an interest rate you think where the buyer side is going to get constrained? Is going to be a constraint on listing improvement?
So the question for those online was, is there an interest rate where the buy side gets constrained?
Yeah.
I mean, quite honestly, I thought interest rates at 3.85% would do it because if you look at when people were buying during the pandemic, people were borrowing at 0.1%. They were assessed at their ability to repay at 2.5% above their mortgage rate. Then it was bumped up to 3%. So you would think that 375 basis points worth of hikes would do it, but clearly households have got a lot of other areas where they can trim back their spending before housing becomes that concern. So I don't know, but I think if households don't stop spending, again, that's another argument for why the Reserve Bank will keep lifting interest rates. I don't know what that figure is. As I said, I thought we would have seen a bigger slowdown in spending, and probably at the start of this year, I thought the slowdown we'd seen in sales would persist this year, but it clearly hasn't. So I don't have a good answer for that.
And what's happening? Any color on what's happening on the off-market transactions in this low supply environment?
So the question there was around off-market. It's something we haven't looked at too much at the moment. I think from our perspective, there's not a lot of competition there. The buyers have come back, but they're certainly not to the magnitude they were during the pandemic, where we know that there was that uptick in off-market. Now, I'm sure there are some off-market still happening. We're certainly hearing about some, but I think the vast majority of people know that at the moment it's better to test the market and go and see what price you can get from everyone, rather than just relying on someone that the real estate agent has on their database that they think is giving them a good price. So in terms of the new housing construction, we are seeing a big pullback in new dwelling commencements. Now, the data's only up to December. We can look at monthly building approvals. There's been a further fall in building approvals over recent months. So tradespeople still have a lot of work. The number of dwellings under construction is slightly below its historic peak, but it's still very high on a historic basis. And that's because, again, projects take a lot longer to finish now than they used to. But we are, the concerning thing is we need a lot more housing and we're getting less new housing. And also for tradespeople, they've got a lot of work on at the moment, but in 12 to 18 months' time, when those projects come to an end, there's going to be less work for them. And I think you talk to developers and they say, well, we're not going to reduce our price, but let's revisit that in a year to a year and a half's time when they don't have as much work. That's when we might see the price of new housing start to fall. And we might even see some developers having to sell off those sites that they bought right at the peak because they just don't stack up anymore. So we've only got 15 minutes left. I'll quickly touch on commercial listings. So just a very brief one slide on here. So this is looking at new commercial listings. So for sale listings are 10% higher than they were 12 months ago. And lease listings are up 7%, but you can see the number of properties available, new listings on the market for sale and for lease are certainly down quite a lot from where they were in 2019, and they're down for lease from where they were in 2020 as well. So the commercial market's slowed up a little bit, but still stronger than it was last year and the year before. I do want to quickly touch on some of the things more broadly we're seeing in the housing market, and I do definitely want to leave some time for some questions at the end as well. So in terms of prices, so far this year we have seen a rebound in prices. You can see in Sydney it's been quite significant, a 1.4% increase. Nationally, prices are up 0.8%. Over the last 3 months, you can see Melbourne, Brisbane, Adelaide and Perth have seen prices rise. The smaller capital cities, we've seen prices fall, and it's a bit mixed in the regional areas. But we've certainly seen a pick-up in things so far this year. We have seen a slowdown, though, from where we were 12 months ago. You can see Sydney, Melbourne, Hobart and Canberra have seen the largest year-on-year declines. Even the areas where we've seen prices higher over the last 12 months, the rate of growth has slowed from where it was 12 months ago. And if we look at where prices are compared to their peak, so nationally prices are down about 4%. For houses, down 1.6% for units. Again, the houses in the more expensive areas have seen the biggest falls, and certainly units in Sydney and Melbourne have seen the biggest declines from the peak. The peak was about April, it was in April last year, so that's what we're looking at. But prices are significantly higher than they were at the start of the pandemic in most areas. Note that in Melbourne, unit prices are only 0.8% higher than they were at the start of the pandemic. And even house prices in Melbourne, the growth there has significantly lagged behind what we've seen in other parts of the country. Also, regional markets have generally seen stronger price growth than capital city areas. In terms of the sales, as I talked about, there was kind of this narrative that no one was selling, and that was no one was buying properties, and that was certainly the case late last year. You can see that green line there, which is what happened through 2022. You can see that as interest rates went up, we saw fewer and fewer sales. We didn't see that rebound in sales in spring that we usually see. But fast forward to this year, our sales are certainly not back to where they were at the start of last year or the start or in 2021. But remember, that 2021 was the best year in about a decade for sales activity. So we're doing better than we were in 2019, and we're doing better than we were in 2020. So it's definitely not the case that there aren't people out there buying. There has been a rebound in people buying over the first 4 months of this year. Challenge again, there's a lack of stock for them to buy though. Which brings us to what's happening with inquiry. So the number of inquiries per listing is unchanged from a year ago. Now, how we measure inquiry, there's 4 types of inquiry. There's someone using our app or our website to either email an agent, phone an agent, SMS an agent, or someone saving an inspection time on our property. Now, we know that a lot of people don't necessarily do any of those 4 things and will turn up to an open for inspection. But, it's a good measure over time, and you can see through the pandemic it peaked when basically you had to get in touch with an agent if you wanted to buy a property. Now you can just turn up to an open for inspection. But we can see the capital cities are unchanged from a year ago. Regional markets, a significant decline in inquiries per listing. But again, have a look at some of the larger capital cities. So in Sydney, you've gone from 19 inquiries a year ago to 23 inquiries this year. In Melbourne, a very negligible change, a slight decline. Brisbane, a slight decline as well. Perth, from 9 inquiries to 10 inquiries over the past 12 months. So, quite mixed throughout the market, but certainly here in Sydney, a big uptick in inquiries per listing. And then that takes us to how long a property takes to sell. So a year ago, properties were taking 35 days. They're spending 35 days on our site. It's now 42 days. Most markets have seen an increase. But again, if you look at places like Sydney, Melbourne and Perth, the change in days on site has been very negligible. And actually, compared to where we were sort of the second half of last year, properties are coming off site quicker now. And then you look at other areas like, say, regional Victoria, it's gone from 38 days a year ago now to 59 days this year. So a big upswing in how long it takes to sell a property in those areas. And interestingly, when you look at within Sydney and Melbourne, so again, the inner suburbs of Sydney and Melbourne, generally days on site's now lower than it was 12 months ago, or pretty much unchanged. And then you go to places like the Central Coast, you go to the outer southwest of Sydney, you go to the Mornington Peninsula in Victoria, quite a large increase in days on site in those areas. So again, just that whole people wanting to come back in closer to the city, and the blue chip areas doing better than some of the less blue chip areas. And then we look at what's happening with people selling their properties. And so what we do here is we look at the difference between the price at which a property is originally listed for and compare it to what price it's sold for. And you can see, so a year ago, about a third of properties were selling at a discount. Now it's just under 50% of properties selling at a discount. But you can also see that it has started to drop over the last couple of months. And you can see, fairly moderate changes in Sydney and Melbourne, really large changes in some other areas. So the share of properties selling at a discount in Brisbane has doubled over the year. It's gone from 12% to 45% in Hobart. So again, you can see that, during the pandemic, it was a pretty uniform market where prices were rising everywhere. Now we're finding a lot of different conditions depending on where you are across the country at the moment. And I did want to jump into the rental market as well to talk about that. So if we look over the last 3 months, we can see that rental prices in the capital cities are up 3%. Regional markets, they're up 1%. If we look over the last 12 months, prices for houses are up 8%, unit prices are up 10%. But have a look at Sydney and Melbourne. Unit rental growth is more than doubled house rental growth over the last 12 months. So big pickup there. Really strong rental growth still in places like Brisbane, Adelaide and Perth. And in the regional areas, rents are still rising, but the rate of rental growth has really pared back from where it was 12 to 18 months ago. If we look at through the pandemic, so house rents are up 26%, unit rents are up 17%. But look how much lower rental growth has been in Sydney and Melbourne. So even though rents are now picking up quite significantly in those two markets, rents aren't that much higher than they were at the start of the pandemic. And to me, that actually says there's probably a lot further to run with rental growth in both of those cities when you compare it to somewhere like Adelaide, where house rents are up 28%, unit rents are up 26%. Have a look at Perth, rents are up about 40% across both property types in just over 3 years. And then rental yields. So yields fell basically to record lows during the pandemic. They're starting to rise because rents are rising faster than property prices. But from an investor's perspective, interest rates are the highest they've been in a decade. And you can go and park your money in a high interest savings account and get 4.5%, 5% on your savings. And I think for a lot of investors, prices, yes, they've risen a little bit over the last few months, but is that going to continue? Yields are low, the rental market's tight, they're going to go further. So is there really a strong enough impetus for investors to take their money out of a risk-free asset and put it into residential property at the moment, particularly because banks are lending them significantly less, so they can't get as good of a property when they're trying to buy now, as even they could have at the peak of the peak of price growth sort of 12, 18 months ago. So I think that's another reason why we aren't seeing investors return. In terms of inquiry per listing, it is down 5% from where it was 12 months ago. It's up in the capital cities, significantly lower in the regional markets. But again, have a look at Sydney and Melbourne. Inquiry is higher than it was 12 months ago in those markets. The highest number of inquiries per listing is in Perth, though. 33 inquiries on average per listing for a rental property in Perth, 32 in Adelaide, 26 in Brisbane, 25 in Melbourne. So unfortunately, one person gets the property and then everyone else is out there, and then we're adding a lot more people every single day that are coming and moving here from overseas. There's more and more people looking for that rental accommodation. So this is why it's really tough for renters, but also why landlords have a lot of scope to put up rents at the moment. And then vacancy rates. So capital city vacancy rates are down from a year ago, from 1.9 to 1.4. Melbourne, 2.5% a year ago, 1.4% now. Sydney, 1.6% now from 2% a year ago. But then go and have a look at Perth and Adelaide. You're looking at a 1% vacancy rate in those markets. And that's probably where Sydney and Melbourne are headed over the next 6 to 12 months. We know that most people migrating to Australia end up in Sydney and Melbourne, and there's just not enough housing stock for them. And then days on site. So properties are leasing in 21 days compared to 20 days. We got this abnormal jump in April. We're not really sure what's driven that. It could just be sort of a 1 month jump and we'll see things return. But generally speaking, you can see days on site is lower than it was a year ago. And when we talk to real estate agents, the feedback I get is, yeah, it takes us about 20 days to pull down the ad from your site. But the reality is, you put up the ad, you have the open for inspection, you get about 25 or 30 applications for the property. We work through those applications. One person gets it, and then we take it down off your site. So when I show this to property managers, they say, look, the reality is probably 7 days that we're really looking for someone to rent, if we haven't even found someone to rent it before it even goes up on your site, because we've got such a big backlog of people looking for rents. So what's that all mean, and where do we think things are going from here? I think more broadly, if we look at the housing market, over recent decades, I think there's been 4 drivers of price growth, and that's been credit became a lot more freely available, and that was the case from about the early 1990s to about the middle of the 2010s. Now it's all about macroprudential policies, you know, asking a lot more questions when you take out a mortgage about your expenditure. It is harder to get finance than it was 10 years ago. And I think we're going to continue to see those conditions in the market. The other one was obviously interest rates. You know, back in the early 1990s, they were 18%. They basically went as low as they could possibly go. Now, they've ticked up a little bit, but they're still very low on a historic basis. And we know that decline in interest rates certainly contributed to price growth that we've seen over recent decades. And the other one is workforce participation. Over the last few decades, we've seen a lot more, particularly women, joining the workforce. And, you know, that boosted household incomes and allowed people to pay more for properties as well. The one that we've still got that's very strong as a driver of price growth is migration. And it doesn't look like that's set to change. But I think looking forward, we probably can't expect property prices to rise in future decades as they have over the more recent decades that we've seen. At the moment, though, the lack of stock on the market, the lack of new properties coming to the market is really the thing that is driving property prices higher, along with that uptick in sales we've seen. In terms of inquiry, it has come back from where it was at its peak, but it is still above the pre-pandemic levels. And days on site is a little bit higher than it was a year ago, but it is starting to ease back over recent months. In terms of the rental market, you know, it was all about regional and outer rental markets through the pandemic. Now it's all about middle and inner rental markets where the demand is. Yields are low, but they're lifting. The supply of rental stock, though, is really constrained. And the answer to the rental crisis is more supply. Now, there's 2 ways to get more supply. Build more. We should do that, but you start planning that now, it's 5 years off. Or get more investors back into the market. But for investors, you know, charged higher interest rates, borrowing capacities are trimmed, state governments are grabbing more in land tax from you. The price growth that we've seen over the last 2 years is only just starting to be reflected in the land tax bills as well. Tenancy laws are swinging more in favour of the tenant as opposed to an investor. And now a lot of the feedback we're getting is for investors, it's just getting too hard, and it's just easier to exit and, you know, go and invest in the share market or park your money somewhere else where you don't have all those stresses. In terms of leases, you know, properties are still going to lease very quickly. I think for me, there's 2 big questions for this year. Will investors come back into the market? And if they do, when will they? Again, I think if they are going to come back into the market, that's probably when we get that stability in interest rates. If we get a cut to those serviceability buffers, that's when we might see them return. And the other one is first home buyers. So it's overwhelmingly cheaper to be renting a property than it is to be servicing a mortgage at the moment. In saying that, if you're faced with a 10% increase every single year on your rent, or you run the risk of getting turfed out of your rental accommodation because the landlord wants to sell it at the end of your lease, I think increasingly people will go, you know what, I'm going to bite the bullet. Federal government will go shared equity with me. You know, they'll do low deposit. I can take up some of these schemes, and I'm going to get my own property rather than the uncertainty that that rental market has at the moment. And that is the end of my presentation. I'm happy to take any more questions that we've got either online or in the room. Yes.
In terms of short-term rentals, you got any sort of sense of how that's impacted the market?
We have, I mean, data's a bit hard to find. Basically, have a bit of a look at AirDNA, what's happening there. So the number of short-term rentals is still nowhere close to where it was before the pandemic, but it has picked up quite a lot. And I mean, the fact of the matter is, with interest rates higher, people are looking to maximise their return. And in certain areas across the country, you can get a way better return putting your property in Airbnb or stays than you can putting it in the long-term rental market. So it's certainly a source of competition in the rental market that historically hasn't been there. I wouldn't be surprised if we see more legislation coming about trying to discourage people putting their properties in short-term though, especially as this rental crisis rolls on. I mean, that would be a lot more popular than introducing a rental cap like some of the state governments are talking about. So I think it does impact on the market, but I think there's a lot of factors impacting on the rental market at the moment. Is there another question?
Based on all this, is it fair to say the assumption that you have is prices probably tick up low single digit over the next 1, 2, 3 years?
Sorry, I didn't.
Prices. Just your thoughts on where prices go for the next 1, 2, 3 years, and also very specifically, a second question is, what does that mean for listings? I know we talked about the disconnect that's happened over the last 3 months, but also over the next 1 to 3 years.
So the question was about prices in the next 1 to 3 years, and then what that means for listings. I think what happens with listings is going to drive prices more than prices will drive listings. I feel like if we were to get a lot more stock coming onto the market, then price growth would be weaker. But if we continue to see this tight market where we're not seeing a lot of stock coming to the market, then we're going to see those price pressures re-emerging and prices will continue to grow. So we don't really have a price forecast, and we certainly don't have a listings forecast, as I know you're aware of. I think at some point we will see people more prepared to put properties onto the market. We just don't know when that point is. I mean, we'd like it to be today, but it's clearly not at the moment.
Maybe as an extension of that, historically they've been pretty well correlated to each other, and we obviously highlighted the disconnect over the last 3 months.
Yeah.
But is there a stage where we should expect that relationship to come back together, or?
So for those online, the question was, historically they've been fairly closely correlated. We've seen that disconnect so far this year. When do we think it comes back? We haven't officially put down any thinking about when we think that's going to return. I think the big factor here is, interest rates are rising and they've risen really rapidly. And there's a whole 10, 11 years worth of people that have never faced interest rate hikes before that are owning property now and facing their first ever interest rate increases. So I think there's quite a bit of uncertainty, and I think just because we did see that long-term trend, it's a very different situation we're in at the moment.
We probably should wind it up, I think.
Okay, yeah.
I will
Back over to Alice.
I'll say thank you to you, Cam. That was fantastic. Thank you to everyone who's come in for the presentation and those on the screen. If you've got any follow-up questions for Cam, maybe you can bring them through to me rather than going direct to Cam. And yeah, we plan to do these on a regular basis every 6 months or so, just to keep you up to date with what's going on in not only the resi space, but commercial and developer as well. So thank you, everybody.
Thank you, guys.
Thank you.